In this video, Jacob and I discuss our stock market outlook for 2025. Are there more blue skies ahead, or is a crash on the horizon?
Do you think it's a 2021 stock market again, or do you think we're not in a 2021 stock market again? I think from your feeling there, maybe that we're not in a 2021 stock market situation. For me personally, sometimes I do think we're getting a bit bubbly, because then I look at some of these IPOs and I look at the valuations. They go to like 80 times sales, and companies that have no revenue and profit, valued at multi-billion pounds. And then some stocks that I'm sure we're going to get onto a bit later today, some of the growth stocks that you would expect to be crazy valuations if we were in a bubble market. And you've got the likes of growth stocks like Monday.com and Salesforce that are down 40%. So what's your thinking at the moment?
Sure. Yeah, I think my take on it is, the first thing to say is whether there'll be a crash or not. Of course, there's going to be a crash at some point, and recent history has taught us there's so many wild cards we can't predict, right? I know there are a fair amount of people that said, oh, things were getting very hot in 2006, 2007 with the mortgage market, and that was clearly insane. But obviously, COVID was a complete black swan. There was a suspicion that obviously crashed the market a huge amount in 2020. One of the most intense crashes we've had since World War II was when, we all thought that Trump was going to announce tariffs. He was protectionist in his first term, but we didn't know that he was going to announce them to the extent that he announced them. And so you have a lot of wild cards, and there's often something like that crashes the market. That's always the catalyst. But the flip side of that is, let's say if Trump had come in, let's say late 2022, and had announced those tariffs, would have market had a few 5% a day drops? Probably not, because it was much cheaper in late 2022. So it's difficult to know exactly what will be the trigger, but I think you've just got to look behind the scenes and say, our PE ratio on the S&P is a bit higher than usual. I think it's about 27 or 29 right now.
I was going to ask you about
that. Yeah. So there's that. Another thing is that I have particular stocks that I like to look at as a barometer, because obviously there's a lot with that PE ratio. It's kind of hard. You can't really use it in isolation, because there's a lot that changes, and it's different because now we've got faster growing companies that make up the bulk of the S&P. So if Nvidia's got a high PE, it's saying the S&P is more expensive. Nvidia now makes up much more weighting of the S&P. So then it's kind of unfair to say, oh yeah, the S&P is more expensive, because Nvidia deserves a higher PE than companies that were further up the index, like Walmart was further up the S&P 20 years ago and deserves a much lower PE than Nvidia. So what the other thing I like to do is I like to look at extremely general stocks and have a look at their price to sales, price to earnings relative to the past, see how they're doing. Microsoft and Amazon are a good barometer for that. Amazon, I think you should use more price to sales, because their margins are expanding, because their high margin businesses are growing more. So AWS obviously fast growing, and their advertising business. Visa and MasterCard are great barometers to look at, because that's also overall health spending in the economy. So actually looking at the price to sales of particular things, and also just not owning stocks when they are egregiously overvalued. The Trade Desk comes to mind. Actually, I had a video on the Trade Desk, and that's a pretty good company. But that was extremely expensive, to the point where they've had a couple of earnings which were still half decent, and the stock plummeted. It plummeted once, it went back up, and then it plummeted again. I think both of them were 30 to 40% crashes. So when you own a stock that's a bit more depressed in valuation, it'll get less pulled down when you have that macro trigger, and it will also survive better if they have a tiny revenue miss, a tiny earnings miss. And this is also brings on to another point, is particularly in the US growth stocks that I'm looking at, the trading action after an earnings call is insane. The stocks are always moving double digits, aren't they? But that's great, because it creates an opportunity. It's like, if it pushes it up to fair value, you can trim. If it crashes, you can double down. And it's sometimes I say, okay, wow, that was bad earnings, and I say, let's reduce the risk here. But most of the time, nothing's really changed about the long-term thesis, but volatility creates opportunity. So the bottom line is to always own good businesses and own them at good prices. But I do think we're definitely more expensive than average in the overall market right now.
So still not 2021, but a little bit of richer valuation.
I'd say late 2022 was very cheap, and since then, because we've had 2.5 really good years since that period where we were cheap, I'd say probably 7 out of 10 in terms of expensive. But that's obviously not a reason not to invest, and we don't know when the crash will be, right?
Yeah.
We might be in the 1996 version of the dot-com bubble, and it might take another 4 years of, oh, AI is going to take over the world, and then you might miss out on that 4 years of growth.
Yeah, yeah. And that's a great thing about being a long-term investor, isn't it? That you don't have to panic about these situations. If we are in 1996 again, then we just sit back and then the returns come in. And if we do get a 2022 situation again and it's like shooting fish in a barrel, then we take those opportunities and we'll go buy them and hopefully have another good year like 2023, 2024, 2025.
Absolutely. Yeah. So if you can get yourself to the point where you're always saving a bit of money, again, not financial advice, but if you're always, you have a sort of monthly amount that you can get into your portfolio, and that just allows for a bit of cushioning, so if you do think the market's a bit bubbly and a bit too overheated, you can just pull back a bit, and then you've still got the money coming into your portfolio, the cash, so that when it does crash, it gives you that opportunity when there's blood in the streets to buy more of your favorite stocks.
Have you been trimming a little bit at the moment?
Yeah, I have a larger cash position than I did. There's actually a video that I did on macro and economics back in my channel on October 2024, and I was talking about why I think the market was a bit expensive, and a lot of that still stands. So I have a much higher cash position than I did, and I'm balancing that with a few dividend stocks and some corporate bonds, not to return a great deal, but just to at least have a yield coming in that's higher than cash. And there are some stocks, some dividend stocks that actually have a negative correlation with the market. Whenever they crash, the dividend stocks, they at least tend to hold fire, but they sometimes go up. So I'm just balancing that a bit, just in case we get like a 20% haircut and I want to really double down into growth stocks that have crashed.